Okay, so good morning, everyone. Welcome to this weekly preview from the Macro Shop. I'm doing this on Monday, January the 19th, 2026 in the morning. It's Martin Luther King Day. So the cash markets, of course, are closed today. So let's just go through quickly what are the big things moving the markets probably this week. There's not a huge amount of data. We do have the initial jobless claims. We have some slightly old GDP coming up. We have some PCE coming up. We have the Bank of Japan, which is going to be important in terms of sort of the Asian markets later in the week. But really, the big question is going to be what's happening over in Davos in Switzerland for the World Economic Forum. Trump is scheduled to speak there on, as far as I understand, on Wednesday morning, so January the 21st at about 8:30. And it seems as though there's going to be a lot of meetings between Trump and the heads of the various countries and perhaps even the European Union, because we all know that Trump has sort of ratcheted up the pressure on Europe over Greenland, threatening sort of 10% tariffs, which could be raised to 25% tariffs. So there's all kinds of permutations here. On the other hand, we're going to find out, is this just a sort of a maximalist bargaining and negotiating position? Will Trump do another taco and by sort of Wednesday or Thursday say, hey guys, I don't actually mean it? So we'll look at all those things during the week, and that's going to be quite interesting. Why is that going to be important? Because the idea here is that Europe has talked about retaliation. This will have implications potentially for the European stock markets, for the American stock markets, American sort of technology companies. There's also the idea that defense spending is going to have to be ratcheted up even more, sort of increased even more, so that could be positive news for European defense contractors, maybe even American defense contractors. On the other hand, there could be more bond issuance, which could cause long-term yields to go up and curves to steepen. So apart from just the geopolitical interest of everything, we also have potential sort of issues in terms of the markets. Okay, other thing which is interesting this week. We've been waiting for that for a while, but potentially the decision by the Supreme Court of the United States, SCOTUS, so to speak, on the legality or not of Trump's tariffs, in the sense that, do they sort of come under the purview of the sort of Emergency Powers Act, or indeed, do they need to be sort of voted upon and approved by Congress, or do they need another kind of statute in order for them to be legal? The point is, the last couple of weeks, the market has been expecting those decisions. We haven't had that decision. There's talk that it could happen again this week. And again, as I've alluded to in sort of our previous videos, it could be the case that if the Supreme Court says it's all good, no problem at all, is that going to be good for bonds? Probably, because the reality is that these tariffs have brought in quite a lot of income. At an incremental level, the US sort of deficits have gone down a little bit. So the bond market likes that, less issuance, potentially downward pressure on yields. On the other hand, if the Supreme Court does come in, maybe this Wednesday and say, hey, this all has to be reorganized, go back to Congress, use different statutes. In the meantime, temporarily, these tariffs need to come off. The bond market, especially at the long end, is not going to like that. We're going to get a steepener, because the bond market, I think, will say, okay, one could argue less tariffs at the margin, a little less inflation, although there hasn't been a lot of inflation coming through. But the reality is that would indicate potentially higher deficits, higher sort of bond issuance, which means higher yields. And of course, as we get higher yields, that's not great for the stock market, especially interest rate sensitive stocks. So we do have the SCOTUS decision potentially this week, and that's something to be looking out for. Other possible sort of main thing happening this week, I've just got up here, is the choice for the Fed chair. Now, Trump, of course, has been teasing us, saying it could be one of the Kevins, Kevin Warsh or Kevin or Hassett, maybe not, because he's actually good on TV, or even the head of Rick Rieder. So we'll see what happens there. And just in terms of the Fed, what the market in a broad picture, as we all know, is concerned about, is that if someone is too close to Trump, the idea here is that the market might think that there's going to be, the Fed might be too dovish in a relatively strong economy that could overheat the economy, could bring back inflation, and could cause, again, more pressure on the long end of the yield curve because of, inflationary pressures. On the other hand, if Trump is seen to appoint someone or recommend someone who's a little bit more independent, the bond market will probably like that, and there'll be an easier passage through Congress. Anyway, the thing is that there could be a decision on the Fed chair this week. And let's just have a quick look to see where we're at with the Fed. As we probably all know at this point, for the January meeting upcoming in, about 10 days or so, Actually, when is it? The 28th of January. We can see here what the market is pricing in according to the Fed funds futures. And we see that, 95% probability of nothing at all, no cut, certainly no hike. But if we go out a little bit and look further in the year, let's just look through, again, this is where we're at here at the moment. We're at between 350 and 375 basis points in terms of the Fed funds futures sort of target range here, or the Fed funds rate target rate. And in terms of the first cut, we don't really get the highest probability of a cut. We really have to go out, and until we'll go back onto the different meetings. So if we go, let's say, to April, we still don't have anything. If we go to June, you have a little bit there. So basically June is the first, but as you can see, the probability distribution is still quite low. There's still 35% chance of a no cut by June. There's a little, the market maybe 18% is saying 2 or more cuts. So, in theory, mathematically, 1 cut by June. And then if we actually look at the aggregated sort of numbers in terms of probability distributions, by the end of the year, let's just go to the end of the year here. So December, we can see that overall, the probability weighted distribution, 88%, is for 2 cuts by the end of the year. So all that to say in simple language that we're not expecting much for the next 3 or 4 months. Maybe by the beginning, the beginning of summer, June, July, we could get some kind of 1 cut and then maybe 2 cuts by the end of the year. Now, of course, what the market needs to decide is, if Trump does appoint someone who's perceived to be more dovish, who is, happy to cut, more than 50 basis points, 100 basis points, 125 basis points in a strong economy, how is the market going to react? Probably not. Well, the stock market might rip, but I think gold will rip, but it's going to put downward pressure on the US dollar and upward pressure on long-term yields. So this is all what we're trying to look at this week. As I say, all of the above. Okay. If we actually now look at, let's just have a look at some of the big sort of trends which are moving markets here. So I just want to go here into just a few sort of ratios, which I do like to look at. So let's first of all just have a look and see like what's happening between the stock market and the bond market. And you can see here that this is ITOT over government. So ITOT is the totality of the US stock market, and GOVT, government, is essentially sort of a broad index or broad ETF of bonds. And what we can see is that the stock market, the stocks were really favored over the bonds going until, sort of going into towards the end of last year. And what we can see at the moment is that the stocks are still grinding up on a relative basis versus the bonds, but overall that is starting to flatten out a little bit. Okay, so if we look now just globally, let's say look at another big trend, US versus the rest of the world. How's the world perceiving, all of this geopolitical risk, potentially downward pressure on the US dollar, a lack of Fed independence, etc. How's that looking? So if we look at SPY versus IXUS, now IXUS is essentially the rest of the world's stock markets versus, as a benchmark SPY. We can see that was, on Liberation Day here, the SPY underperformed, but then, the US, the sort of exceptionalism story came back, but essentially since then, pretty stable. But just recently, let's call it, basically after Christmas, the beginning of this year, we're starting to see the US stock market underperform against the global stock markets. And so there does seem to be some rotation going out of US stocks on a comparative comparative basis compared to the rest of the world. We also look at SPY versus VEA. Now, VEA is developed markets. You can see again this underperformance in terms of the US stock market, definitely a bit of money going out. If we look here at the emerging markets, let's have a look. This is where it starts to get very interesting. And this is just because definitely rotation happening out, a lot of money going into emerging markets. Some of those sort of emerging markets like Brazil or Vietnam or Korea. I mean, Korea is not exactly an emerging market, let's say a developing market, absolutely. But a lot of non-classical developed markets getting a lot of flow as there's considered more stability, more central bank stability, a weakening US dollar as well. So, emerging markets on a comparative basis really starting to outperform the S&P, which is interesting, getting down to an interesting level there in terms of that ratio. You can see here, maybe that'll sort of stabilize a little bit. Now, what happens if we exclude China? So now we look at emerging markets excluding China, and you can see here that it's, if anything, it's actually stronger. So it looks as though China, just going back to the emerging markets, EEM, which includes China, so that's done well. But once you exclude China, you can see that it's done even a little bit better. So, a pretty strong trend here of emerging markets, especially excluding China, starting to outperform the US. Now, what about the US equity market itself? We're seeing some quite significant rotations here. So if we look at SPY over QQQ, that's relatively stable. You can see here again on the daily chart here, that ratio is relatively stable and has been so for the last couple of weeks or so. But where we're really starting to see some action, for the last week, 10 days, is SPY over IWM, which of course is more or less the small caps and the Russell ETF. And you can see here that the Russell really outperforming, or you could put another way and say the SPY underperforming. So a strong, obviously money is drifting out of the broader SPY and is on a relative basis is going towards the small caps. And we can see here that the breadth of, there's different ways of looking at that, which we'll look at a little bit later, but you can look at the breadth is definitely widening out. So you can also say, okay, what about the QQQs against the Russell? And you can also see that the NASDAQ, so the tech stocks, also underperforming. So not only the broader SP 500, but also the broad NASDAQ is underperforming. So definitely a broadening out, a widening of the base, and that at the end of the day is going to be quite bullish. Now, what about RSP? This is actually the sort of equal weighted sort of ETF, and again you can also see this is not actually technically the Russell; it's just the equal weight, and you can see here that on an equal weight, that's also outperforming the S&P, or you could say the S&P is underperforming the equal weight. So again, we're getting this whole idea of the Mag 7s, money sort of going out of the Mag 7s, maybe more towards the equal weight. Where else could it be going? So again, we can look at SPY over the some of the discretionaries, and you can see here that's a little bit choppy. But if you actually look here at the at the XLP over XLY, you can see that the consumer discretionary outperforming as well. And then, so it's interesting, but the one I really want to sort of put our focus on here is the semiconductors. This is really, I think, really what is telling the story here. So if we look at SPY divided by SOXX, which is one of the indices for the semiconductors, you can see that that is also underperforming. So it looks as though, and then you say, well, okay, what about the broader sort of tech sector? So if we go XLK, which is the tech sector, but what we have here is the semiconductors divided by XLK, which is the tech sector. This is a pretty crazy chart. You can see here that the semiconductors is actually outperforming the tech sector. So what we seem to be having here is two principal themes. Number one is that the semiconductors are doing super well, and we see that reflected in things like the Korean index, like the KOSPI in South Korea, which is ripping. So we have very strong semiconductor performance. We also have another strong trend, which is essentially broad-based equal weights and small caps are doing better compared to the general index. So that's something to be looking out for this week, is whether those sort of relative performances is going to continue. That's definitely two very strong trends. So we'll look out the semiconductors, we'll look out for equal weight. So maybe SOXX, SMH, and maybe you'd be looking for RSP, something like that as well. Other interesting thing is just looking at credit quality, which I haven't looked at for a while. So what I've got here is the high yield sort of unhedged or hedged credit, and then you've got the LQD, which is the investment grade. And I'm just trying to understand whether there's any sort of credit stress. And the reality is this is quite bullish, because in terms of risk on and risk off, what we're seeing here is that this is relatively stable. You can see here that if anything, high yield is doing relatively well. And keep in mind that the further up this goes, it's more sort of risk on. So if high yield credit quality is outperforming the investment quality, that's a bit of a risk on. And that's essentially saying the market is not seeing a huge amount of credit risk. And as you can see here, that's pretty stable. It's certainly not deteriorating, which you'd see in a moment of credit, risk. The other thing which is kind of interesting here, just in terms of the US and the US dollar, in terms of global credit, what I've got here is VWOB, so VWOB. Now this ETF looks at emerging market credit, but denominated in US dollars. So that's emerging market credit, excuse me, denominated in US dollars, which is, obviously sensitive to the US interest rate, but also just perceived a global risk. And then I've got that divided by emerging market local currency. That's emerging market debt, but denominated in the local currency, not in the US currency. That's considered a higher risk. And what you can see here is that basically the emerging market sort of debt, which is denominated in US dollars, is actually underperforming the local currency. You see, that's been quite a strong trend now for 2 to 3 months or so, and so that's telling us a couple of things. It's telling us that first of all, the US dollar is weakening because in general, when the US dollar weakens, that's easier for emerging markets to repay the debt. But just in terms of credit quality and risk globally, this is quite a risk on and a pro emerging markets kind of a story here, because it's basically saying that the market is rewarding and is comfortable, relatively comfortable, with emerging market debt denominated in local currency. So it's basically saying, hey, we've got US dollar, which is kind of weakening. So there's more money flows going to emerging markets. So that for me, along with this sort of credit rating here back in the US, is, saying that, credit globally and in the US is not particularly under pressure, which all things considered would be a relative sort of risk on sort of signal. And, overall is quite a positive. Now, we know that Trump is constantly trying to throw the geopolitical problems everywhere, but at the end of the day, a lot of other stuff in the markets, a lot of these ratios are relatively positive. If we want to have a quick look at some commodities as well, I'll just have a quick look at SPY over gold. Gold continues to be very strong. So again, gold is and the precious metals in general, but specifically gold and silver, as we know, and we'll get onto that a little bit later, but they are obviously taking some of the strain, some of the concerns about sticky inflation, some of the concerns about geopolitical risk, some of the concerns about a lack of fiscal discipline everywhere, not only in the US, but sort of in Europe and Japan and well, sort of globally, maybe not China. So gold really outperforming the SPY. You see SPY over GLD is down, but that's been the case for quite a long time here. You can also see that gold, is outperforming oil. USO, so gold outperforming oil, although it is sort of stabilizing a little bit. So that's an interesting one to keep an eye on. Okay, I'm just going to grab some water. All right, so much for the bigger trends. If we actually I just want to have a look now and look at some bond markets. Let's have a quick look here and look at some bonds. What it basically is happening here, if we look at some of the yields here, you can see that the front end of the yield, so look at the US 1 year starting to creep up a little bit. If we look at the 2 year, also pushing higher, and that's interesting because we have global collateral. We have the Fed funds rate, which is around about 3.64, I believe. Just have to triple check that, but basically around about that. And basically the bond market is saying, okay, that's sort of enough. We don't believe that the Fed funds rate is going to go down too much more. And we just looked at what's priced in for the Fed. And, obviously the 2 year yield is looking, a bit further out here. But it's an interesting technical level here because we're seeing that the 2 year yield is starting to break out of this sort of, is this like a rounding bottom kind of thing, or sort of a basing sort of formation here? And you can see this downtrend. So what is going to be critical for the 2 year yield? I'd say 3.636. That could be some sort of short-term cap. We need to see what Trump does with the new Fed chair. But basically, there is some concern in the sense that the data has been relatively strong. There is a sort of a sense as well that with Powell pushing back against the Fed, that maybe even if Trump wants ideally to sort of dominate the Fed, it may not be so easy. And so the front end of the bond market, at least in the US here, that the yields are starting to tick up, based on the fact that, we've priced in a couple of cuts for 2026, as we saw. That's probably enough for the time being. As I say, based on the fact that, Powell and the Fed as an institution seems to be giving a bit of a pushback. We also had some Republican senators last week essentially saying to Trump, hey, don't try and foist someone on us who is not going to be sort of responsible. And also the economic data is doing quite well. So that's the level I'm going to be looking at. I think, for sure the 2 year yield can get up to, as I say, the 3.63, 3.64, which would be, the Fed funds rate. There's probably going to be a little bit of a cap on it there. But if we look further out, what we can see as well is you see the 5 year pushing higher. You see the 10 year breaking out of this little box here, this sort of range. So this is actually quite critical here, or quite interesting, because the 10 year, which has been trading in this box, capped at about 4.21%, you can see that on Friday, it broke out. Now, because it's Martin Luther King Day today, the bond market, cash bond market, is closed. We've obviously had a little bit of risk off, so some of these yields might be pulling back a little bit today on Monday. But essentially, the 10-year yield is starting to push higher. But you can also see the 30-year yield also starting to push higher as well. So we're starting to get a little bit of this steepening again. And if we just look at that, we just look at the steepener here, or look at, like, say, the twos, tens. They had been flattening quite a lot, but we're starting to see a little bit of steepening here, and that to me is probably a reasonable idea. Why did the curve flatten? Let's just look and see why the curve flattened. The curve flattened not basically because the front end yields pushed higher, as we saw. There was some, it's a relatively strong data. There was pushback from the Fed, from Powell saying, hey, we're not going to be that dovish. So we had the front end yields pushing up. So it was a front end led sort of bearish flattener here. So the front end yields going up compared to the low end yields. And that's what pushed that the curve flatter. But I think maybe that's done at the moment, and now the market might sort of refocus back again on sort of bond issuance and basically the general economy and bond issue and what's happening, as I say, the general economy, which is going to be important for data. So if that's the case, the front end yields have gone up enough. As I said, maybe going up another 2 or 3 basis points, but essentially stabilizing. And then the long end yields could start pushing up a little bit higher. So if we look at the 2s, 30s, starting to steepen here, but we also see the 2s, 10s steepened on Friday. And if we look at, let's say, the 5s, 30s, still, actually, they didn't steepen. That's interesting. So really, that steepening was to do with the Fed. So just note the difference here between 2s, 30s and the 5s, 30s there. There's interesting there. Now, if we go over to Europe, I want to look at the European yields here. Again, if we look at the front end of the curve here, we can see that the yields have come down quite a lot, around about 2%. And that's just because the ECB is basically saying, hey, we're relatively happy where bond yields are at the moment. There's no real need to hike. There's no real need to cut. So we're seeing bond yields in the European space, in the German space here, at about 2%. Now, what's interesting is that if we continue to get sort of attention with at Davos, with Greenland and all this kind of thing, how could the market react to it? I think we could get a bit of a steepener here. And let's look at the 10-year yields. You see the 10-year yields in Germany starting to push higher. And I do believe maybe the 30-year yield could push higher as well, because this could indicate that what could happen. If there's reciprocal tariffs, we could have less growth in the European space, potentially more need for stimulus, potentially more need for sort of defense spending and government intervention, which is more bond issuance, which is going to negatively affect the long end of the curve. So again, I think this is a little asymmetric. If we do get a weakening of the US economy because of increased tariffs, that means that yields at the front end might actually come down a little bit, and we might see the ECB having to cut interest rates a little bit more. And on the other hand, the issuance and needing to support the economy and more infrastructure spending, more defense spending, that could start to put some upward pressure on the long end of the curve. So I think it's going to be interesting here to look at the German yield curve. So let's look at, let's say, the 2s, 10s. You're already starting to see that steepen, and could it get back up to levels like at 82, 84, 85 basis points? And if we look at, let's say, the 2s, 30s, could that at least retest that recent high of 1.4? And if we look at the 530s over in Germany, again, there's plenty of upside possible, 1.06 as on the 530s yield spread. So my point here is that I do see there's a definite sort of potential for steepening in the German curve and European curves in general, basically based on this idea that the front end could be anchored or even go a little bit lower on the need for the central bank, the European Central Bank, to support the economy, but the governments need to still be issuing medium and long-term bonds to, for defense infrastructure and maybe just generally supporting the economy. So that's something definitely to be looking at as well. Now, just in terms of the differentials, we can have a quick look here and just see what's happening here. So if we look at the front end of the curve, so this is the US 2-year versus the German 2-year, and you can see the differential starting to blow out in favor of the US. So that means the US yields are going up much more at the front end than German yields. You see a big, strong move. And again, based on the strong US data, based on the fact that the Fed is pushing back and hawkish repricing compared to potential worries over in Europe about the front end of the curve. And again, that's what I was trying to say. The front end of the curve in Europe might be stable or even going a bit lower, but in the US, strong economy is starting to push up the Fed expectations well, less Fed expectations for a cut. So that's blowing out. And then if we look at, let's say, the 10 to 10, you can also see that's starting to push up, and the 30s not so much. So it's really at the in the twos, and to a certain extent the fives there. So that's ordinarily that should be a positive for the US dollar against the euro as well. So that's something to look out for. Just finally, just want to look at the yields here. Let's have a look over in Japan. Now we know that we have a Bank of Japan decision coming up on, when is that? Thursday night, our time. Let me just have a look over here. Yeah, scheduled to be about 10 p.m. Thursday night, North American time, Eastern time in the US. Now, look at this Japanese yield here. You can see the Japanese yield on the 10-year now up to almost 2.3%, just going straight up, even starting to go a little perpendicular. I'm not going to say parabolic at this point. And that's kind of logical in a certain sense, because we still have the Bank of Japan buying a huge amount of bonds. There's sort of a soft yield curve control. They're still trying to keep those yields relatively contained. But the reality is that the Japanese, the government, the debt to GDP ratio is about, I think, 240 or 250 basis points. Very, very high compared to other sort of nations. We also have the potential for a snap election coming up in February. Takaichi wants to call a snap election. She's riding high in the polls. She's popular. And we know that if she wins with a bigger majority for the LDP, Liberal Democratic Party, that she could want to do some sales tax reduction. And this is what was the immediate catalyst for this, that she was talking, there was rumors swirling around over the last 2-3 days that if Takaichi is to get a bigger majority, she wants to push forward some stimulatory sort of measures, maybe cutting sales tax, things like this, issuing extra bonds, stimulating the economy. And that, of course, is all a little bit inflationary, extra bond issuance. None of that is good for the back of the Japanese curve, which, as you can see, is pushing higher. And that also is going to drift out into the rest of the world bonds. So the US, the UK gilts over in Germany, France, Italy, et cetera, Australia. So again, more pressure on the back end of the curve. Now, ultimately, will this start to cause upward pressure for the Japanese yen? At this point, I think the market, we'll look at the chart in a second, but at this point, the market really is saying, hey, Japan, you still need higher yields on the long end. And this is encouraging, air quotes, in a certain sense, because at a certain point, the market will start to say, hey, if we start to get to 2.5, 2.75% on the Japanese 10-year, one could start to argue that's getting to a reasonable yield, which is adequate. And we could start to see the Japanese yen start to appreciate. So that's an interesting one. In the meantime, that's where I've got this up. You can see over in China here, only at about 1.9%. So Chinese 10-year yields are still quite low compared to the rest of the world. And let's just keep in mind that the Chinese, they're dumping a lot of stuff, they're exporting a lot of stuff. But just doing some research over the weekend, the Chinese real estate market is very, very weak. The average sort of housing cost has come down. A price of apartments has come down, 20%. Some people saying that's the official number. Some people saying the real number is more like 30 or 40% compared to a few years ago. So many Chinese households who would put their savings into the Chinese real estate, they're under a lot of pressure, and they're holding assets which have depreciated markedly with no immediate sign of a turn. So let's not underestimate the fact that the overall Chinese economy and consumer is still under pressure. And there's no easy fix here. So that's just something to keep in mind here in terms of China. Okay, so enough for bonds. Let's just now have a look at some of the currencies here, guys. So we'll just put on some FX. There we go. Okay, so let's have an overview here. Now, the dollar, what's going on with the dollar? You can see here, we got to a key technical level. So the key technical level was this 38% fib retracement here, which you can see was also horizontal resistance. Let's call it about 99.5. So that was technical resistance. But we can also see, I'm just going to throw in a couple of moving averages here just for a little bit of perspective. Just give me a second. Sorry, where are my moving averages? Here we go. So the 20s, 50s, 100s, and 200 EMAs. So you see here we couldn't get up to the 200 EMA, but we did get rejected at the 61.8 fib retracement. Now, a lot of that is the geopolitics, apart from the technicals. Obviously, with Trump, putting more pressure, Greenland, all of this geopolitical stuff, there's a potential attack on Iran, there's potential, what happened in Venezuela with Maduro, etc. So there's a sense here that the US dollar is not acting as a safe haven in that situation. Fiscal irresponsibility, geopolitical risk going on, US dollar selling off. So what's it selling off against? So we saw the euro having a pop. We saw obviously the Swiss franc are doing quite well. So USD CHF down. Now, interesting to see what happened with the USD versus the Japanese yen. We just spoke about the Japanese yen here. You can see here that the Japanese yen didn't particularly pick up a lot of energy. I mean, that again, this is USD JPY. So you can see here relatively stable. So Japanese yen still showing a certain amount of weakness. And it gets back to my point that the market, in order for the Japanese yen to significantly strengthen, we'll need to see significantly higher yet yields in the 10 and the 30 years. It wants higher yields. So even though the yields are going up, it wants probably another 50 or 100 or 150 basis points, at which point it says, okay, these yields now accurately reflect the fiscal sort of situation, the fiscal situation of the country. So interesting that the traditional safe haven, Japanese yen versus the US dollar, didn't do that well on last night's sort of geopolitical risk. Kind of interesting. And you can see that, for example, US dollar against the, a number of currencies like the real, against the peso, the South African rand, these emerging market currencies, very, very weak. And against the Chinese, the renminbi, you can see against the yuan, down a lot as well. So even though we just saw the Chinese yields are quite low, the US dollar not really appreciating any shape or form. So, the US dollar is structurally weak at the moment. Now, if we look at, as I say, just some overviews here, maybe we'll look at, let's say, something like Euro CHF. Very interesting classical reaction, quick little trade on that one, with that sort of a political risk seeming to be heightened internally in Europe and between Europe and, let's say, the US. You can see here that the Euro Swiss under pressure, so selling the Euro, buying the Swiss franc. That's a pretty classical reaction here. We see Euro JPY. How did that react? Again, as I said, interesting that even in that sort of, more potential risk in Europe, that the Japanese yen couldn't really do too much against the euro. So again, we're seeing that the Japanese yen is still pretty weak. On a comparative basis, we see the euro is weaker than the CHF, so the Swiss franc. And then intra-Europe, you can see something like the Swiss franc versus the Swedish krone. You can see up strongly as well. And even I wonder if I have the euro, the euro versus the up against the Swedish krona. So you see the hierarchy here, that the high beta currencies, the high risk currencies like the Polish zloty, the Swedish krone are the weakest. In the middle, you sort of got the euro, and then the strongest, you've got the Swiss franc. And then globally, you have the Swiss franc, as always, with these low interest rates and low inflation outperforming everyone else in these times of stress. So what's going to move the euro? As I just said, we're going to get the political risk. Is that going to stabilize? Is the risks of tariffs? You've got to say that if tariffs start to be sort of introduced, reciprocal tariffs, we know that the European economy depends a lot on exports. So any threat to the exports is going to be a negative for the euro, especially on a comparative basis compared to something like the Swiss franc. You've got to say that that's going to be a negative. In terms of the US dollar, I mean, just getting back to the dollar, what's going to affect that? I mean, obviously the US dollar at this point, it wants to see fiscal responsibility. So it wants to see a Fed which is independent and essentially is combating inflation. It wants to see strong data, and probably it wants to see a little bit of a de-escalation in sort of just risk in general, and geopolitical risk, and a little bit more stability. So if we get, let's say, continue to get strong data, inflation remains a little sticky, but not too sticky, not crazily out of control. And we have a more independent Fed, or a Fed which is perceived to be more independent with less cuts. I do believe there is potential for the US dollar to, remain, in this zone here. It doesn't necessarily have to collapse. But if we start to get softer data, maybe softer inflation, a Fed which is cutting, maybe even cutting too much, and a little bit of uncertainty and the lack of consistency from the White House, could the US dollar, especially against things like the Swiss franc, could it deteriorate? Yes, it could, absolutely. Now, in terms of the yen, we did speak about that a little bit. Let's just have a quick look here. Again, where could the yen go? Again, it depends a little bit, obviously mainly on the US dollar. What we need to see for further yen strength, which would indicate this sort of coming down here. At this point, as you can see, the chart still very, very bullish. Like, technically, if I just arrived from Mars here, I would say, well, the US JPY probably wants to retest this level at 159. There's been some talk of intervention by the Bank of Japan or the Ministry of Finance, but to be honest, last time they did that, we got up almost to 162. I don't think that's really a real possibility until we get up maybe 160, 161. And as I said a week ago or so, the Bank of Japan is loath, does not like to intervene just before an election because it's seen as being too political. So I do believe that, if Takaichi does call the election and she does win, we could actually see more weakness because the market is essentially equating a more stimulatory government with a less fiscally responsible government, which is a negative for the yen. So, I do believe that if the USD stabilizes a little bit, there could be more upside here for the yen. Okay, guys, so let's just have a quick look here and look at some commodities and metals and whatnot. So just looking at the gold. Now, obviously, gold last night popped just on the perception of increased political risk. You see here, it's still, we just look just technically here, gold, this is the gold futures. You see here that it's sort of in this sort of rising up channel. Could it get, up to 4,700? Why not 4,725? That would be the top of the channel. You can see here that all of the moving averages, everything's very, very positive here. All Fibonacci retracements are being bought. I mean, at the end of the day here, gold is it's an inflation hedge. It's a geopolitical hedge. People talk about the debasement trade, fiscal irresponsibility in a lot of developed nations. This is doing very, very well. And if you look at gold priced in Japanese yen, for example, you can see I think it's even more parabolic. I don't know if I can bring this up here. I'll try and bring it up here. I think we'll do XAU JPY. Let's have a look. Yeah, so you can see here, again, very, very, very high. Okay, so the point is that any kind of currency which is perceived to be sort of weakening from a fiscal point of view, be it the Turkish lira or the Japanese yen, or obviously something like what just happened in Iran with a huge devaluation of the rial in Iran. Gold is really fundamental. Now, people will argue, say, oh, it doesn't yield anything, it's difficult to store, etc., etc. But the reality is that, for 2,000 years, gold has been a store of value. And clearly the proof is in the pudding. So gold doing very well, also on the geopolitical risk. Again, what could be the risk to that? It's hard to see. We'd have to see less central bank buying. We'd have to see fiscal responsibility global, so less debt issuance. We'd have to see a turning down of all the geopolitical stuff. Remember, we had Gaza, we had Iran, Venezuela, maybe Europe and the US, Greenland. God knows what's going on. I don't see any reason in the short term for gold to fall dramatically, and at the moment the technicals are still there. Similar situation with silver. Silver, of course, also has about a 50-55% industrial usage, even more so than gold. This is an incredibly bullish chart. I mean, if we break this down, let's say to a 4-hour, you say, well, where could this go? I mean, just doing some Fibonacci extensions here, I will just measure out a couple, or this one here. So if we just do something like this, I mean, the next targets, I mean, let's just call it $100, but it could go to 102, 105, 106, 107, definitely can extend. Now, will there be some short-term resistance at, let's say, 94.5? That's absolutely possible. But at this point, there's definitely sort of more room overhead. And we can even do something like this, which would be, I mean, you can argue a very, very short term. It's not the greatest one here, but you could say that, it could be a little bit of a pullback here, but you could also argue that another fib extension there, the 1.618 could be up to 57.5. So the point is that silver has more to go. What was the interesting thing for me is that copper initially in sympathy last night, you see, had a pop, but I don't think it was justified because presumably with more tariffs globally, more trade wars, that is not the best kind of sentiment for copper. You also see here that copper, there is some kind of Fibonacci, this is on the 4-hour chart here. If we look at a Fibonacci level here, we'll just bring this in. You can see here, just from this down impulse from the 15th of January, you see here it failed at the 61.8 fib retracement, 5.93 on copper. So that was a good place for it to fail. And as I say, I don't think it was justified last night at the open, copper popping high, because I don't think it's a different dynamic. Copper is much happier with strong global trade, less tariffs, etc., etc. So I think here copper could pull back. Then, of course, what you'd want to do is to maybe say, well, okay, the bulls need to come in at some kind of Fibonacci sort of entry point. Okay, let's just move on. Have a quick look here at some of the commodities. Actually, I want to look at sort of oil. So let me just go to oil. Sorry, guys, just bring it up. All right, so oil, we know what's going on with oil, with the potential still for attacks on Iran. Trump, he said, oh, the Iranian authorities were no longer sort of shooting sort of demonstrators, but we know that the U.S. fleet, the aircraft carrier fleet, is steaming across the Indian Ocean, is getting closer and in range. And the idea is that in a couple of days, that military force will be in a position, and a very strong position. So I'm still personally thinking that an attack on Iran is not impossible. You can see here that oil pulled back a little bit. So let's just have a look here at some of the technicals. You can see here that if we look on the daily chart, you can see here that it pulled back to the 61.8, which was about the 200-day EMA. Had a nice bounce there. At this point, this is still relatively bullish. So at this point, as I say, it bounced off the fib level, it bounced off the 200-day. It's now breaking out. The next, it's above the 200, the 100, and the 50-day EMA. So at this point, this is still looking relatively bullish. Now, of course, there's overhead resistance here, I would say about the 59.5 level. That's a horizontal resistance. We also have the next targets up at about $60. So that's a key zone. Now, if I wanted to, again, this is the 4-hour chart here. So those levels on the 4-hour chart. But if we now look what the bears need to do, for me, it's pretty simple that first of all, we do have a bit of resistance short term at about 59.60, as I mentioned. But really, I think what's going to be the critical level on the front contract here is this 38% fib retracement, which coincides with $60, which also coincides with the high on January the 16th, you see. So the $60 for me is really the line in the sand. So at this point, I do see potentially some upside. And obviously, if we get some kind of geopolitical escalation in Iran or just more generally, in Europe, potentially that could push higher, but especially an attack on Iran. On the other hand, the bulls, once they get there, they need to keep pushing that higher. On the other hand, if the bears want to come in, as I said, that $60 level is a beautiful place to be thinking about shorting. So that would be the line in the sand for me on that. So that's about it. Just in terms of some other things, we obviously have the equities. We have a lot of earnings this week. I will just try and bring those up. The earnings calendar, I do forgive me. I meant to put those up a little bit earlier. Let's have a look. Sorry, I just have to get my share screen here. Sorry, just bear with me here for 2 seconds. Share screen. There we go. So here's the earnings calendar. So we don't yet have all of the huge tech companies, but we do have some pretty interesting ones here. We have 3M, we have D.R. Horton for the home builders, and that's going to be important. Their forecast going into the future, not only their past performance, but their expectations for the future. We know that the White House is very, very focused on getting mortgage rates down. There's talk of using 401ks, withdrawing money as down payments. So D.R. Horton's, which is a major home builder in the US, that's going to be interesting to get their forward guidance and just general impressions of the US housing markets. We have some regional banks. We have Netflix. That's always going to be interesting in terms of the situation with potentially Paramount, Warner Brothers. Are they going to be taking over Warner Brothers? Are they going to fend off the Paramount sort of a bid as well for Warner Brothers? United, obviously, for the airlines. And just so Netflix and United, interesting in terms of consumer sentiment. In terms of the staples, we have Johnson & Johnson. That's, of course, going to be important. Halliburton, Kinder Morgan. Again, these are kind of oil service companies. So that's going to be important in terms of the whole Venezuelan thing. Do these companies perceive that there's going to be more opportunities, as pushed by Trump in Venezuela? So let's keep an eye on Kinder Morgan in terms of pipelines and Halliburton for general oil services. In terms of other stuff happening, just looking here, P&G, obviously for sort of consumer staples, Intel in computer space, GE, always interesting in terms of defense, aerospace. And we know there's a lot of stuff going on in terms of defense and, budgets and Trump even talking, remember a week ago, talking about $500 billion extra dollars for the US defense budget. So plenty of interesting things happening, but probably it's going to be the following week. So next week where we get even more earnings. Okay, guys, I'm going to leave it there for the moment. It's gone a little bit longer. So as I say, just a bit of an overview here for the week upcoming. Let's keep an eye, as I say, on Trump's speech. Probably the most important thing is going to be Trump's speech 8:30 on Wednesday, I do believe it was. Yeah, Wednesday morning over in Davos in Switzerland. And just generally any headlines which we're getting out of the those meetings at the World Economic Forum. And again, there is the potential, if we do get the taco trade, we could see things like the DAX index and the Euro Stoxx 50, the Euro Stoxx 600 have a big push up as well. If the taco trade comes in and Trump actually decides that he doesn't need to be putting tariffs on, we could get a big risk on a boost. So that's something definitely to be looking out for as well. And that could be a good excuse for gold, for example, to come off a little bit, and maybe silver, some of these precious metals, just to calm down a little bit as well and get a pullback in the yields. Okay, so leave it there, guys. Have a great trading week, and I'll be back tomorrow with the macro snapshot from the macro shop. Thanks very much.